A tough start to the month for equities ahead of some key econ data out this week. According to our next guest, one survey could indicate where markets are heading into this year. And of course, at the start of earnings season, a couple of key things to keep in mind. Let's get into all that with Willem Sels. He's a global chief investment officer at HSBC Global Private Banking and Wealth. And Willem, it's great to see you again. We want to get into that bank lending survey. But first, I just want to get your thoughts on earnings, because one thing that stuck out to me in your notes as we get underway with earnings season here this week, you said you're focusing on areas of the market that can deliver earnings endurance. What does that look like? And what is the thing that investors should be watching for as they're trying to determine the companies that can deliver that earnings endurance?
Yeah, so what you're seeing in the equity market is more and more within all of the sectors, a lot of dispersion. So it becomes more difficult for a strategist to actually tell you where to put your money. And it's more an analyst, actually, the stock pickers, who are going to do that. That being said, the earnings season, has actually a relatively low bar in the third quarter. Remember, the second quarter, the bar was high and companies still beat it. In the third quarter, for some reason, the analysts have become more negative, even though the companies guided positively and the economic data, as you saw, for example, in the payroll data and the wages and the unemployment data, the economy is actually doing quite well. So I do think a lot of companies are going to, beat, those relatively conservative earnings expectations. And therefore, what we do is we broaden the sector exposure, but within each of the sectors, we let the analysts pick, those companies that are, the most resilient.
I'm curious, Willem, you talk about how we are going to have this resilient earnings growth, but you also say there's going to be some pressure on PE ratios moving forward here. Where does that leave us heading into earnings?
So not necessarily a lot of pressure on PE ratios, but it's not from the PEs that or the multiples that the equity expansion will come. It will come, indeed from those earnings. I do think that the bond market has already priced in a lot of the cuts, actually potentially a little bit more than what we expect. We expect only 6 further rate cuts of 25 basis points. So that will not necessarily allow for further expansion of PEs, but it needs to be those earnings. The good news is that, the market is now looking for a no landing or a soft landing scenario. Soft landing even better, to some extent than the no landing, because indeed, if you were to have a no landing scenario, then the market could start to price out, remove some of those rate cuts, and that could lead to some of some multiple contraction.
Well, when you take a look at the recession factor and how that plays into these calls, especially with earnings, when we're trying to figure out the stability of these earnings, the growth that we're going to see not only this quarter, but looking ahead into fourth quarter and 2025, what does that then tell us about what you think the odds are for recession and how important that is to this call in terms of the rotation and the outperformance that we could see in other sectors?
I see recession risk as relatively low. The Fed as well has confirmed, or in their opinion, that they don't see it as an imminent threat. They if the risks to the economy were to increase, that they are ready to cut more. So I think to some extent you have that Fed put. I don't think we actually to some extent need it, because the economic data are strong enough to avoid us sliding into that recession. So that's the economic momentum. I think from a fundamental and a more structural perspective as well, you have a lot of support for the US economy in particular, which is everything around innovation and the infrastructure build out in particular, together with the supply chain reorientation and the re-onshoring. All of that puts a floor on their economic growth. So I would suggest that people don't worry too much around recession risk.